Greetings and welcome to the CCOF Foundation Financial Planning 101 webinar. We are very excited to have you here with us today. Our speaker, Brett Melone from California FarmLink, will review the basics of financial planning for farmers. Before we begin, I wanted to thank the USDA Risk Management Agency for funding this webinar. This is the first webinar in a four-part series supported by RMA. And additional webinars in the series include a webinar on crop insurance and a couple webinars on organic record keeping. I also wanted to note that any opinions, findings, conclusions, or recommendations expressed in this webinar are those of the authors and do not necessarily reflect the views of the U.S. Department of Agriculture. So if you're having difficulties connecting to the webinar, if you can't hear or can't see, please call our office for support at 831-423-2263. Press 0 for the operator and someone will help you connect to the webinar. My name is Megan Donovan and I'll be your host today. I'm a program specialist at the CCOF Foundation. The CCOF Foundation advances organic agriculture for a healthy world through education and hardship grants, technical assistance, and consumer education. Before we get started with our presentation, I wanted to review a few housekeeping items and let you know how you can participate in today's web event. We're looking at an example of the GoToWebinar attendee interface, which is made up of two parts: the viewer window on the left, which allows you to see everything the presenter will share on their screen, and the control panel on the right. Within the control panel is how you can participate in today's event, so let's take a look at that. By clicking on the orange arrow, you can open and close the control panel. From the view menu, you can also set the control panel not to auto-hide when inactive if you prefer to always have it open. The audio pane provides audio information. By default, you have joined the webinar via mic and speakers. If you prefer, you can join the audio via telephone by pressing phone call, and the dial-in information will be displayed. During the presentation, you can send our webinar staff questions through the questions pane. Simply type your question and click send. And throughout the webinar, we will stop from time to time for questions from the audience. As a reminder, today's webinar is being recorded and everyone will receive an email with a link to view the recording of today's event, along with a PDF of the PowerPoint slides. So you don't have to worry about taking really fast notes or writing down web links. You'll get a copy of all those. So we wanted to encourage you to test out the questions pane and write in. Let us know where you're calling in from today and what you produce on your farm or ranch. And also, we have a really big crowd in the audience today, which is great. And we will try to respond to as many questions and comments as we have time for. And we just wanted to apologize in advance if we can't get to your specific question, and encourage you to follow up with us after the webinar. We'll have everybody's contact information available. So thanks again for attending. And without further ado, I will introduce our speaker, Brett Melone, who has served as the Director of Lending at California FarmLink since July 2014. Prior to his current role, Brett worked as a FarmLink loan officer and served as a member of the California FarmLink Board of Directors and Loan Committee. Brett has more than 15 years of experience supporting the business success of farmers, as well as leading nonprofit organizations that serve farmers. Brett received a bachelor's degree in International Relations, Business, and Spanish from the University of San Diego, and a master's degree in International Environmental Policy from the Monterey Institute of International Studies. So Brett, thank you for being here with us today, and I will turn the presentation over to you.
Thanks so much, Megan. Good afternoon, everyone. I'm pleased to be here. Thanks for spending some time with us today to talk about Financial Planning 101. I hope that you will take something of value from the presentation today and look forward to learning from you as well. So as Megan mentioned, I am with California FarmLink, and we have a mission to link independent farmers and ranchers to the land and financing that they need to be successful and for a sustainable future for all of us eaters and folks that live on this earth. And we are a community development financial institution, which is a designation or certification that the Department of the Treasury provides, and I'll talk a little bit more about that later, but we serve farmers and ranchers as well as agricultural landowners, and we are working on being able to serve other food system actors in the near future as well, folks that produce food products that maybe not be involved in agricultural production. And we take an approach that is client-focused and provide technical assistance around land and capital access. We have a particular focus on supporting historically disadvantaged and minority farmers. We do a lot of work around credit building and referrals, which I'll talk more about. So really briefly, some background on our Access to Land program. We have a self-service linking platform on our website. We provide assistance around developing land tenure agreements and initiating and sustaining succession planning processes involving family and non-family members. And in the access to capital, again, we provide quite a bit of technical assistance around preparing to apply for financing, building credit, business best practices, which are going to be the primary focus of today's discussion, all with the aim towards being able to access credit if you need it. And we have some loan products that are designed specifically to serve farmers and ranchers. And here's just a sampling of some of the types of technical assistance and professional referral partners that we work with, depending on, you know, the particular needs of the farmers that we're working with. So just a brief overview of today's presentation. Given the topic and a new tool that FarmLink had the chance to help develop over the last couple of years, I wanted to take the opportunity to introduce those of you who are not familiar with something called the Farm and Ranch Business Health Assessment. It's a framework for managing risk in agricultural businesses, and it has 8 components, which are listed there on the screen. But we're going to spend most of our time focusing on 3 of those components: the business formation, accounting, and credit pieces of that business health assessment. We're going to touch on all of them briefly, but focus most of our time on those 3 areas. And as Megan mentioned, this webinar is the first in a series of 4, and the next webinar in the series is listed there, coming up on June 19th, which will be covering the topic of crop insurance for organic farmers, and we're going to touch on that briefly today. And as Megan mentioned, we will have a good bit of time for Q&A as well. So this is just an image of the first page of the Farm and Ranch Business Health Assessment, and this tool was the brainchild of Poppy Davis, who's a renowned sustainable agriculture consultant. She has extensive expertise in agricultural law and taxation. It was funded by the USDA Farm Service Agency and developed as a collaboration among 3 organizations: California FarmLink, Sustainable Agriculture Education, and the Agricultural and Land-Based Training Association, or ALBA. And you can find a fillable PDF version, both in English and in Spanish, on FarmLink's website. And then if you're interested in a hard copy, kind of in booklet form, to send us an email, and we'd be happy to mail one to you. The other great thing about this tool is that there are several fact sheets that have been developed and are part of the tool right now, and there are additional fact sheets being developed. I think there are 6 fact sheets, so there isn't one for each of the components of the assessment quite yet, that we're working on developing additional ones, but the fact sheets, I'll touch on some of them briefly in the presentation today, and I encourage you to check them out. And then one last note about the assessment in terms of its scope. We, along with our collaborators, are reaching out to farm support organizations around the country about utilizing this tool, rolling it out. The idea is that you, as a farmer or rancher, can develop a kind of a customized learning plan and see change over time. And so we're hoping that the folks around the country will begin to use it, provide feedback. So if you work with an organization in California or in any other part of the country and have think they might be interested in learning about it or utilizing it, please share it with them and let us know if you have any questions about it. So let's dig into this business health assessment framework now. And the first section that we're going to cover is business formation. And so we want to just take a pause and do a poll here and ask what type of business, how you have your business structured. Maybe it's a sole proprietorship, a general partnership, one of several types of corporations. Perhaps it's a co-op or a benefit corporation or something else. So please participate in the poll and let us know what sort of business structure you have.
Yeah, so you're going to see the poll kind of show up on your screen. And if you just want to go in and select your answer and click send. And as we're waiting for people to kind of fill out the poll, just wanted to loop back around on where people are from and what they're producing. And so we have a bunch of folks from all around California: Salinas, Big Bear, Davis, Creston, Hollister, and the Central Valley. And also a big diversity of crops, row crops, fruit trees, mixed veggies, some flowers, avocados, dragon fruit, chirimoya, and apples among some of the crops that our people are growing. So we'll take a couple more, give people a little more time to respond, and then we will close the poll and take a look at what people are producing. So you kind of see the bar graph there. Looks like we have some sole proprietorships, and corporations seem to be the largest amongst those who are own their business. Do you have any comments on that, Brett?
So yeah, so it looks like sole proprietorships are the largest percentage, right? 32%, and that's consistent roughly with kind of sort of the national, what's typical. The vast majority of small businesses are held as sole proprietorships. And it looks like for several folks, it's close to 40%, it doesn't apply. So maybe you're not in business or not in business yet. So we'll talk about these legal structures briefly and just talk about an approach to thinking about business structures and how to limit personal liability in this next section.
Great. So I will continue on with the presentation.
Great. Okay. So if you haven't incorporated your business, then you are either you're the owner of a sole proprietorship or a partner in a general partnership. So those are the three broad categories: sole proprietorship, general partnership, or corporation. And as was noted on the previous slide, there are several types of corporations. Something to keep in mind as the owner of a sole proprietorship or a partner in a general partnership is that personal responsibility is unlimited, or you have unlimited liability in that business structure. And what that means is that any debts or legal liabilities of the business can be enforced against any one of the individual owners, as well, including personal property or wages, including of a spouse of an owner who does not own or work on the farm. So it's a pretty significant amount of risk that you take on being the owner of a sole proprietorship. And by sharing this information, we just hope that you'll think about the implications of that and possibly look into the benefits of incorporation and when might be appropriate to be incorporating and what the approach is for that. So to dig a little bit deeper on the topic of incorporation, it's a legal method for limiting personal liability. So an individual or a group of individuals can incorporate an entity, and the way you go about doing that is filing articles of incorporation with the state that you reside and operate the business in California. It's the Secretary of State. And state statutes allow the incorporated entity to be essentially a distinct legal person. So the corporation can own property and conduct business, and can also can sue others and be sued. So this separate legal status of the corporation allows the individuals who are owners or members of the corporation to invest in ownership without being exposed to unlimited personal liability, again, including their spouses. So the liability of the corporation is not unlimited, it's limited to the assets of the corporation. So you essentially are creating a legal firewall between the individuals that are the owners or members of the corporation and the corporation itself. Well, that firewall is not foolproof, but it is one of the best strategies for business owners and farmers and ranchers in particular to limit liability and to protect family wealth. So, and the land is typically the most valuable asset that a farmer or rancher is going to own, and want to give credit to Poppy Davis here for conceiving of this kind of diagram, and she does a much more eloquent job of conveying how to understand this. But I think it kind of speaks for itself and really encourages you to think about how do the people that are doing activities on the land relate to each other in a legal context, and in terms of thinking about limiting personal liability. So people are carrying out the activities of the business, and they, again, may be the owner of a sole proprietorship or a corporation. There are employment agreements between the people and the entity that's carrying out the activities. Now, the entity that's carrying out the activities in a scenario where you're trying to limit personal liability as well as corporate liability, often that entity that is conducting the activities, actually doing the production, selling the product, is going to be a separate entity from the one that holds the land. And so there can be the same people that are owners or members of a corporation, typically a limited liability corporation that holds ownership of the land, can be the same people that are the controlling owners or members of the entity that carries out or conducts the activities, but you're constructing your business in a way that you're limiting personal liability and also limiting corporate liability. So there's a fact sheet in the business health assessment that goes into a good bit of detail on these topics. It also has some additional resources there, so I strongly encourage you to check those out. And now we're going to talk just a little bit more about some specific farm legal structures. So this is a more complete list. And as I mentioned earlier, the vast majority of businesses in the U.S. are sole proprietorships. And the great thing about them is that they're really simple to create. You really don't need to do anything, technically speaking, from a taxation perspective to reporting to the IRS and to the state taxation agency to establish them. Depending on the line of business, there are other things you'll likely need to do, such as in the case of agriculture, ranching, register with Ag Commissioner, but to actually have a sole proprietorship and be able to report income, all you need to do is let the IRS know that you're doing that. And your income on the the income that you're taxed on is done at the individual level. So some of these other, and that's the case for general partnerships as well. In the case of corporations, in particular C Corp and S Corp, the way that they are taxed varies, and we really encourage you to talk to an attorney as well as a CPA, a certified public accountant, before deciding on a legal structure. And one of the things that I often point out when you're thinking about this is to consider how you are paying yourself in the business, or how you would like to pay yourself. Some of these structures are more appropriate for a situation where you're taking a draw when there are funds available versus paying yourself as an employee and reducing the tax liability of the corporation before it pays taxes. So you'd be increasing your expenses by paying yourself a salary, but that's just one thing to consider. So, yeah, I guess one other thing I wanted to mention was that a benefit corporation, or many of you probably heard of B Corps, the benefit corporation is the designation that the IRS uses and other states, and it is, I think, a subchapter of IRS code that is covered under the C Corp, if I'm not mistaken. So it's not actually, it has some specific characteristics that are unique to it, but it is a type of corporation already. So something to look into if you're wanting to, hold yourself to that standard. And the B Corp certification is actually in addition to what requirements the IRS and any state would have around being a benefit corporation. So they're not identical, but they are similar. So the next section of the business health assessment is land. And I'm not going to spend a great deal of time on this, but I just want to cover briefly a couple of concepts and point out some resources for you. So land tenure essentially means the legal rights to access and use land. And you can obtain that access or the tenure by owning the land or being granted access by the owner, typically through a lease or crop share agreement or something like that. So, I imagine if you're operating on land, you know what the agreement and terms are, but I encourage you to think about, if that arrangement is optimal for you, or, if you think there might be an opportunity to improve upon the arrangement to address your needs and for managing risk. And these are some of the, oops, just lost my screen here. These are some of the types of ownership agreements and lease agreements that you can develop. Sorry, everyone, I just lost my connection to the webinar. I'm assuming you can still all hear me.
Yes, we can hear you, and we can still see the screen.
Great. I'm just going to get back in there. Bear with me a second. I don't know what happened. So there is a resource there that's linked called Growing on Solid Ground, A Farmer's Guide to Land Tenure, which is a valuable resource, and I encourage you to look at that and thinking about ways that you may be able to strengthen your land tenure arrangement. And if you're in California or in a state that has a land link organization, encourage you to reach out and see how we might be able to help strengthen your lease agreement, either if it's up for renewal or if you're looking for a new piece of land. And Farm Commons is another great resource for all types of legal documents for farmers. Definitely worth checking out. So I'm back. Let's see here.
So why don't we, while you're working on that, we can kind of open it up for questions. So if people have questions about this section that we've just covered, please send those in. And the next section that we're going to be coming up next is the accounting section. And we also just kind of wanted to get an idea of what type of bookkeeping systems you're using on your operation. If you have a computerized bookkeeping system, you have a ledger, are you using QuickBooks, so write in and let us know that as well. So, Brett, are you having any luck on getting the screen back up?
Yes, I'm back.
Okay, good. So we had a couple questions come in about business structures, and one was wondering, how does sole proprietorship with insurance compare to incorporating?
That's a great question. Well, definitely the insurance is extremely important, and so you want to do that by all means, and most farmers markets require that these days. So that's great. And the difference, in my understanding, and I'm not an attorney, so be good to we can get a more thorough response to this. But in a sole proprietorship with insurance, the insurance is going to ideally be the first. There's going to be coverage there for whatever the liability that you're exposed or your business is exposed to is, but then the whoever is suing you or whoever has filed, has obtained a judgment against your personal assets is going to be able to access your personal assets and those of your spouse as well. Whereas in a corporation, at least in theory, they're not going to be able to do that because, again, there's that firewall between the corporation that presumably would be producing the products and maybe someone got sick and sued you, and they would be going after the insurance of the corporation and then the assets of the corporation first. I say in theory because it's not unheard of for there to be suits filed against, the owners of a corporation. And I think, that's outside my area of expertise, exactly, how that can unfold. But by incorporating, that's one of the most, basic things you can do to limit your personal liability.
Great, thank you. And sort of related to that, is it necessary to retain an attorney to file an article of incorporation?
Great question. It's not technically, and there are resources such as on NOLO and other places, LegalZoom, I think, where you can, and even on the Secretary of State website, it lays out what you need to do. So it's not so much in the filing, in my opinion, where you'd be served by an attorney, but in determining the appropriate legal structure. And so, as in anything to do with accessing professional services that are costly, do your homework, be a good consumer of that information. And if you're going to access an attorney, you'll be able to limit, the time you'll need to spend because you will go in there informed. So you don't need an attorney to file the articles of incorporation, but to be sure that you're choosing the right structure for you, it's highly recommended that you do consult an attorney for that.
And then we had a couple questions related to if there are creative ways for people without legal status to have ownership-like positions in a farm or business.
Yeah, that's a great question. So my understanding is that if you are not a permanent resident or citizen, you are able to still be an owner of a sole proprietorship or of a corporation. And the extent to which you can be contributing and be an active participant and be supportive of that business is going to be influenced by your ability to obtain an individual taxpayer identification number, an ITIN, which looks just like a social security number, but it's not technically social security number. So you can be an owner of a business or a corporation without that legal status. You can obtain insurance. I think the first thing that I would recommend in that type of situation is to do everything that you can that's a best practice in terms of operating a business. And from what I've seen, someone who is not documented can do the vast majority of those things, just like someone who's a permanent resident or a citizen can. Where I've seen folks come up against obstacles and where the creativity, I've seen creativity get involved in this is in accessing government programs. So for the FSA, the Farm Service Agency in particular, they will lend and guarantee loans to corporations or entities, but they do require that the majority owners of the entity are either permanent residents or citizens. So someone who is not documented can be a member or owner of that corporation, but they need to be a minority member. So that's one thing that I've learned that's been valuable in working with families on thinking about how to structure their businesses and purchase land. And I'm sure there are others, but I think I would just encourage you to really, do as much as you can to follow best practices around business management, despite not, having the, not being a permanent resident or citizen.
Great, thank you. So I think we're going to move on to the next section of the presentation, and thanks to everybody who wrote in letting us know what type of bookkeeping systems you're using. We have people that are using spreadsheets on Excel, some people who are not using software, as well as people who are using QuickBooks Online. And so again, if you have questions that come up during the next section of the presentation, just write them in and we'll get them to them at the next question breaks. So Brett, back to you.
Great. And Megan, I'm sorry, I don't know what's going on. I have to reconnect to go to webinar again. So I'm going to proceed, but if you can move the slides for me momentarily, that would be great.
Happy to do that.
Okay. Yeah. Okay, so yeah, so we're going to spend a good bit of time now on the accounting section, and I have pulled some questions from the business health assessment from the accounting section. So just a few things to think about, and these are, you can think of them as best practices. Having a separate checking account for your business, separating it from your personal finances, having and using a balance sheet, understanding, how it is a business management tool, getting the assistance of a professional, either bookkeeper or accountant, to set up your bookkeeping system, or if you have that background yourself, that's great. The beauty of computerized bookkeeping systems is that you can get started pretty quickly, and a lot of the information you can be downloading from your bank and from vendors, customers, and things. But there are aspects to setting up a bookkeeping system that really benefit from the assistance of a professional, and it'll make tax reporting go much smoother. So definitely encourage you to do that. And then, what's going on? I'm sorry, my not able to stay. GoToMeeting keeps closing on me. So maybe, Megan, would you mind just moving the slides for me for the moment, and I will.
Just let me know when we need to move the slides. Everything's up here.
Great, thank you. I don't know what's going on with my computer here. So yeah, and the last question there is, around how do you track money that you're either putting into the business or taking out, and that is an example of a transaction type or transaction types that really benefit from having a bookkeeper or accountant help you establish your general ledger, because it can be confusing, and it relates to the income statement and the balance sheet interacting, and we're going to talk about that a little bit now. So, if you're just a little bit more briefly on that, if you are taking a draw, you really want to be clear about how that should appear in your books. If you're paying yourself as an employee, you're most likely incorporated, and you either have someone helping you with the payroll or you're doing it yourself, and then that would show up as an expense. So, just some things to think about as you're setting up your bookkeeping system and thinking about some of the types of transactions that can get a little unraveling things that you've been doing for a while that may not make sense to those that may be helping you prepare your taxes, for instance, is helpful. So, okay, so if you can go to the next slide, Megan, that'd be great. So there are three basic types of financial statements that we're going to cover today, and probably the one that everyone uses the most, I would guess, is the income statement. It's also known as a profit and loss statement, and it shows how much your revenue is and expenses are for a specific time period. Often you'll generate them for for the year, whether it's whatever your fiscal year is, if it's a calendar year or a fiscal year that you've established, or you can, it can be for year to date. So if you've got QuickBooks, you could run it through yesterday and see what your sales and expenses were if all the information is up to date there. So obviously a really important tool, and it is only as good as the information that you put into it, and keep it up to date by inputting things in a timely manner. The cash flow statement is something that is extremely valuable, but is not used as commonly. And I think it is for a couple of reasons. At least one, that they tend to be more complex, and they're a moving target, and they take a good bit of time to set up and then maintain, but they are extremely valuable. And I'm going to go into a little bit more detail about that in the future in a few slides. And then the balance sheet is another financial statement that is not as often used, I think, by small businesses, and could really assist in understanding the financial health of your business and helping you use it to help you achieve goals over time. So again, we'll talk about that some more. So let's see if I can advance the slides now. Megan, would you advance the slides for me?
Here, I'll move it forward and then give you access again.
Okay. Great. So we're going to use a fictitious farm called Rick's Farm to just look at some financial statements. And this is a farm that grows 6 acres of mixed vegetables, and they primarily direct market through a CSA and farmers markets, and they've been in business for about 5 years. So there we go. Okay, so hold on to that, the kind of profile of Rick's Farm, and we're going to be looking at some financial statements. But just briefly on the balance sheet. So what does the balance sheet tell us? Well, it's trying to balance assets with liabilities and owner's equity. And it can also tell you what the farm value is, which is essentially the same as the owner's equity. And it is generated at a moment in time. So you can look at one at the end of your fiscal year, or you can look at one today. And again, it's going to be as accurate as the information is that you've input that is the basis for generating the report. And so, just as an example, if you see here, it has cash listed there as of May 1st, 2018. So if you haven't balanced your bank statements yet, then chances are that cash number is not going to be up to date. So it has assets on the left side, assets you could think of as all things that have value, monetary value, that the farm owns. So we're focusing on a farm business balance sheet now. And then on the right side, you have everything that the business owes. And what's left over is the owner's equity. And so you can see there at the bottom, at the bottom left, it totals the assets, and then it totals the liabilities. Liabilities halfway down on the right. And then you'll see that the total assets is equal to or balances out the total liabilities and owner's equity. But the owner's equity is essentially the difference between what you own, the assets, and what you owe, the liabilities. So in this case, Rick's Farm, as of May 1st, 2018, he has $48,650 in equity. So in theory, if he were to liquidate his business and he was able to cash out on his vehicles and equipment and sell the crops that he has in the ground, pay off his liabilities, he'd have that amount of money in the bank. So, oh my gosh. Looks like I'm getting hung up again. Megan, would you advance the slide?
Yeah,
Megan?
I will advance the slides.
I think I'm doomed, it looks like. So
We're on the income statement slide now.
Yeah, income statement, great. So, really basic, it's showing you what revenue you have, and then and we'll look at one on the next screen, but then it's about, okay, it subtracts out the cost of goods sold and tells you gross profit. And then the next category of expenses is what is referred to as selling, general and administration, the SGA, or you could think about that as kind of operating expenses or overhead expenses. The cost of goods sold, you could think of as variable expenses because those expenses are going to vary, or it's going to depend on how much production you're going to do. So you're obviously going to have less cost in seeds, for instance, the less acreage you grow, but your rent is probably going to be the same because you have a fixed amount of land for the year. So the cost of goods sold or COGS and the SGA you can kind of think of as variable and fixed costs loosely, if you're familiar with that accounting terminology. But the bottom line is that the income statement tells you what your net income is, and we're looking here at one that has historical income statement for 2016 and 2017, and then projections for 2018. So you can see those 2 years of historical numbers, and then what you're projecting for 2018. In this case, the income statement is set up to show revenue by sources, but depending on what you're going to use it for, what type of information you like to get out of it, you can also look at it by products, and that's particularly useful for projections. So Megan, if you go to the next slide, the cash flow projections, please.
Yep, it's up.
Thank you. So, I think this is the tool that is least used by small farmers that I have seen, and I think could have the greatest impact on their ability to really manage the financial part of their business in real time. And so, it helps you understand the flow of cash in and out of your farm business. I mean, that's basically it. But, is having positive cash flow a result of, the stars aligning, or, is it feasible to be projecting out and being able to see on paper or on the screen when are you going to have negative cash flow, and what steps can you take now 6 months out to be in a position to not have negative cash flow in those months. So the pro forma cash flow is basically the format to project out cash flow. Usually covers a year, and we'll look at one in a couple of slides ahead. But one thing to note about cash flow, and many of you have probably experienced this, where your business may be generating a profit, but you experience negative cash flow during the year. And the reverse can be true as well, where you have a business that is losing money, but there are times a year when you have positive cash flow. So sitting down, ideally, before the year begins, project out, what you expect your cash flow to be to your best ability. There's a lot of assumptions that go into putting cash flow projections together, and I think that's one of the things that makes it challenging to kind of launch into creating them, because there's so much that you don't know for sure. But you make assumptions, and then you can build more accurate projections as you refine your assumptions over time. So would you go to the next slide, Megan? When to do a cash flow analysis?
Yep, we're there.
Great. So again, it's ideal to do a cash flow when you're starting out farming or starting, the season. So every year, ideally, and also when you're considering making a change to your business, whether it's buying a piece of equipment, adding a new piece of land, hiring employees, anything typically that has to do with growth, and when you are looking for financing as well. And, that's one of the exercises that, the lender that you work with will need to do. And the more prepared you are with your own cash flow projections, the smoother that process is going to go. So if you go to the next slide, there's an example of part of a cash flow statement. And the interesting thing is about the cash flow statement is that it's hard to fit it on one screen. And so here we're looking at 2017 cash flow for Rick's farm, but just the last 7 months and only the cash flow in. So, what can we see on this part of Rick's cash flow statement? You can see that, he's generating revenue from CSA, that CSA revenue is spread out fairly evenly across the month. So he probably isn't requiring members to pay all up front at the beginning of the season. He's got revenue from farmers markets and wholesale as well, and that the months where he's got the most revenue are in July, August, and September. Farming is the only source of income for a small business. Typically, when we're putting together cash flow projections for someone that's applying for a loan, we would want to see any off-farm income that's being generated in the household as well. So we don't see any of that here. And we also don't see, there's a line for loan disbursement, but there are no numbers there. So during that time period, there was no projected cash from a loan. So if you go to the next slide, Megan, please, to cash flow statement part 2, now we can look at the bottom part of the cash flow statement where we have the expenses for that same time period. And so, we can see that the total operating expenses, if we look across the months, they're fairly evenly distributed, particularly from June to October. There aren't any months that have a huge spike in operating expenses. You can look at the bottom where it shows ending balance. And so that is telling you that, it's projected at the end of June that you'll have that much in the bank, essentially. And, so that's positive cash flow. When you look across the columns, he's projecting to have positive cash flow throughout the year. And the net cash flow all the way to the right, the $36,936, shows that he has improved his cash position from June. So that's actually for the year. From January. But he's got generated $36,000 more in cash. So he'll be going into January, with a strong cash position. So if you go to the next slide, Megan, please. Connecting the income statement and the balance sheet. I just wanted to briefly provide some tips on how to connect the income statement and the balance sheet. So with the cash item on the balance sheet and looking at the balance sheet at a point in time. So we looked at Rick's balance sheet from earlier in 2018. Earlier, so we're looking at 2017. Bear with me a second. let's see here. So so in 2017, he had $63,000 in sales, and his ending cash position. Megan, if you go to the next slide, you can see his balance sheet at the end of 2017, and here, bear with me a second. So you can see that his cash on hand is $45,106, and that is a function of, the sales that he had in 2017 and the expenses that he had, which in part included liquidating his inventory. So, when you are thinking about your income statement and you see that you have a profit, relating that to the balance sheet, seeing that money, in the bank effectively at the end of the year, I think helps to solidify, that connection. And, going back to something that I think is under utilized in terms of using a balance sheet as a business management tool, is that it will tell you, the financial position of your business at a point in time, but you can also use it over time to see how you can build wealth. So the income statement is telling you what you're generating, typically on an annual basis, but you want to see ideally that you're building wealth for the business and for the owners, and you're going to be able to do that by tracking what's happening on your balance sheet over time as well. So I'm just trying to get back into the webinar, but we'll proceed. If you would go to the next slide, Megan. Rick needs new equipment.
Yes.
Please. So we're just going to look briefly at how taking on financing and purchasing equipment, which are capital assets that show up on the balance sheet, how that how this relates to the cash flow and the balance sheet in particular. So the end of 2017, Rick needs to purchase a used tractor new to him, a greenhouse, and a bot cooler, and so he's looking to spend about $30,000. And you go to the next slide, you can see the cash flow projections there for January through May, where about 2/3 of the way down, there's a section for capital expenditures. So he has tractor, greenhouse, and cooler there. You'll see that those expenses are happening over the course of 3 months. And he had, the cash, according to this, to cover that. If you go to the next slide, you'll see at the top there's a line for loan disbursements, and so he got the $22,000 loan, which basically covers the cost of the tractor, and then he's putting in, his equity or investment in it, is showing up or is being used to purchase the greenhouse and the cooler. So of the $30,000 total cost for these capital expenditures, he is putting in $8,000 of the $30,000. If you go to the next slide, Megan, you can look at the impact that this has on the balance sheet. So this is as of January 15th, 2018, and you can see that the cash position has improved. So he's gotten $22,000 in cash, which is reflected in the cash that's highlighted in green there. And then you can also see a loan from FarmLink that he got on the liability side. So you can see how the balance sheet is constructed. You know, you put $22,000 on one side, you have to put it on the other side as well, you know, similar to a credit and debit system in accounting. And so if you go to the next slide, we can see what his cash position was prior, you know, to getting those loan funds, and that he didn't have, you know, that liability there. And he also received accounts receivable, you know, received payments that were pending, and also made some payments. So those were things that didn't appear on the balance sheet at the beginning of 2018. Okay, and then if you would go to the next slide. Actually so balance sheet beginning of 2018, I think it's 2 slides ahead. The balance sheet at 1/31/18, you'll see that the cash position has reduced, so that $22,000 that he had gotten in the loan was actually used to purchase the tractor. But you can also see that the equipment line item increased by $22,000, which is the book value of that tractor. So the $22,000 moved from cash when he had received it, had been booked as cash when he received the loan proceeds, and moved down to equipment. So a kind of supplemental document to the balance sheet are schedules. And in the case of equipment, you'll want to have a separate schedule that details what equipment you own and what the purchase price was, and then as that equipment depreciates over time, that should be reflected on your balance sheet. And that's something that we see quite frequently, that those values don't get adjusted. And so, you know, remembering to periodically review your equipment schedule and make sure that you're adjusting that, you know, on an annual basis is ideal, if not every couple of years. And you know, when equipment is depreciated on your taxes, the value that it has is often less than what you could sell it for, you know, if it's in good shape. So, you know, you just need to be consistent in how you're presenting the information on your balance sheet. Okay, so if you would go to the next slide, Megan, I would appreciate it. 2018 income statement. And so we are moving on from the capital expenditure and seeing how that impacts the balance sheet, and looking at Rick's historical financials. And note, sure, the year is incorrect there, but he suffered a 30% revenue loss in 2018, we're projecting out, and this is due to disease and drought. So you can see in the net income that he had a loss. And we're going to talk a bit about some options using whole farm revenue protection, how that can be addressed. So let's see here. Megan, would you go to the next slide, balance sheet end of 2018 season, please?
Sure. And also, someone just had a quick clarifying question as to how depreciation is calculated. Is it monthly, or how do you determine the amount?
That's a great question. And I mean, it's basically determined by the IRS, depending on the type of equipment, you know, or what type of asset it is. And so that's something that, you know, your tax preparer or accountant can help you with. And once you do that initially, then it's very easy for that information to be updated. And, you know, things there are ways to accelerate depreciation so that, and depreciation is an expense, which is kind of challenging to wrap your head around because it's not an expense in the sense that it's actual money that's going, out the door, out of your bank account. But you could think of it as kind of deferred maintenance. So as a piece of equipment depreciates, what you're going to need to reinvest to keep it up to par eventually. So yeah, your accountant or tax preparer can help you determine what the depreciation schedule is for any given piece of equipment. That's a good question. So I think in the interest of time, I want to skip ahead to the balance sheet ratio analysis, slide 43, and just want to point out some helpful balance sheet ratios that once you have a balance sheet, you can be looking for some of these. And one of the most common ones that companies use is the current ratio. So it looks at your current assets over your current liabilities. So do you have enough in current assets, which you could think of as cash as the most typical current asset, things that you can liquidate quickly to be able to satisfy current liabilities or payments that are due within the year. So that's a liquidity ratio. Solvency ratio, there are a couple listed there, relating your total liabilities to your total assets, as well as debt to equity. So there are some ranges there showing you what would be a weaker ratio versus a stronger ratio. So I'm not going to go into a lot of detail here, but I encourage you to look into those. And if you have a balance sheet or you're developing one, it's definitely worth going back and and using this, and particularly when you're having a challenge that you're trying to figure out, these ratios can help you calibrate things, help you set goals around where you'd like to be. Okay, if you would skip to the next two slides ahead to WFRP eligibility. I'm not going to go into detail about this, and I know that it's going to be covered on the next webinar, but I want you all to be aware that this exists. It's crop insurance that is designed for diversified operations, and it can help you cover losses. If you go to the next slide, the WFRP loss payment calculation, you can see that if you qualify for the insurance and you've got the records, the record keeping and filing Schedule Fs for your taxes as a farm business is essential to be able to access this type of insurance. But in this particular case, someone that was expecting to have $110,000 in revenue, but only had $58,000 in revenue because of the coverage insurance coverage that they had through the Whole Farm Revenue Protection program, they were able to get an indemnity payment of $30,000. So there's obviously a premium cost to accessing that insurance, but it really is something worth looking into as your business grows, because you can ensure the revenue that you have an historic track record of being able to generate over time. And there are some slides here that provide some basic information about reporting and eligibility and key dates, as well as an insurance agent locator. So go back, to the presentation and look through those. But Megan, if you would jump ahead to the taxation section, that would be great. So
we're on
taxation. Perfect. So, the saying, two things that are sure in life, death and taxes. Filing taxes as a small business, and in particular farm business, is important if you want the business to be a source of income and wealth generation over time. And, you know, there are lots of ways to get support on that, both, you know, paid, and there are lots of free resources. FarmLink has a resource on its website, which is kind of a handbook or worksheets to help you gather the information that you need to then have a tax preparer or accountant file your taxes for you. So, Megan, do we want to do the poll at this point?
Yeah, and I think we're just going to have people write in.
Okay.
So, yeah, do you just kind of how you do you use a tax preparer, or do you use software like TurboTax? So if you could just kind of write in and let us know kind of what type of system you use. And then, Brett, is there more you want to say about taxation, or do we want to open it up for questions?
Yeah, just one thing I want to touch on related to taxation, and it's more about declaring income on your taxes. So one of the challenges that we see farmers facing, particularly when they're trying to access credit, is that their actual income is more than or different from what is on their taxes. And, you know, there are reasons, you know, understandable reasons for that, but it's important to note that a decision about extending credit by a financial institution will ultimately be based on what your taxes show, both historically and, you know, the most recent year. And so we think about our businesses as what we see day to day going in the bank and looking at our financial statements. We may not think about it in terms of what's on our taxes. And the more that those two are aligned, the more you know, successful you're going to be in being able to access financing if you need to in the future to, you know, to grow your business. So I'll stop there, and then if you want to do the poll.
Yeah, so we had a couple of people write in. People are using their bookkeeper is also a tax preparer. Some people use the CPA. And let's see, I think that's what we've gotten in so far. So if you still want to share kind of how you prepare your taxes, go ahead and share that. Or if you have any questions you have for Brett for the past section of the webinar, go ahead and write those in. Just a reminder too that we will be sending out a PDF of all these slides, so you'll have access to them. And let's see. So there was a question on slide 43, and I'll move back up to that.
On the ratios?
I think it was.
Or is it the?
It's the after the right at the Rick needs new equipment on the cash flow. She was wondering why the 38K was in the liability side.
Okay, so on the balance sheet, let's see here. Okay, so this is the balance sheet. Okay, so the 38. Which one?
And we can always look in.
Yeah.
We can follow up after the webinar too, if we want to look at that.
Yeah. That'd be great. I'll follow up directly.
So, and then someone was not clear the difference between the COGS and SAG or SGA. So what's the?
So COGS is an acronym for cost of goods sold, and you could think about that as the specific inputs that you utilize to create or to grow a crop, or to raise livestock, or to bring a tree to production, that you can directly tie to that production. So and those are variable depending on the scale of production that you are engaging in, whereas the SGA, or the sales, general, and administration, you could think of as overhead, or things that are fixed just based on operating your business. And so it tries to separate the things that are tied to your level of production with the things that you really can't modify very quickly, that they're going to be fixed for a period of time. So yeah, and so you can try and they become useful when you're trying to improve your net profit on a particular product, especially if you're doing enterprise budgeting and things, or looking at what percentage of your revenue is cost of goods sold versus the overhead or SGA. So it's a way of separating those two types of expenses, for management purposes.
Great, thanks. And then we had another question about what record-keeping advice do you have for people who don't use the internet, technology, Excel spreadsheets, that type of thing?
Yeah, great question. I mean, a good old notebook works great, and there are, a ledger books that you can use. When I met with a farmer last week, and she was using a notebook, and she had amazing records because she was diligent about documenting things. And as an organic producer, I think in the area of record keeping, you really have a leg up. So all the records that you're keeping for purposes of your certification, those are all represent revenue and expenses as well. And so keeping that paper and having a paper-based system to track those things is it's how we used to do it, and it's still feasible. And you can still work with a tax preparer or book or accountant with those records. It's gonna make things a lot easier at that time. So definitely encourage you to use those. And I'm not too familiar with some of the tools that are that you can access on smartphones, but I think that in the near future, even if you don't have a computer but you do have a smartphone, some of those kind of productivity tools are going to be accessible, I think, and affordable for folks. Something to kind of keep an eye on.
Great, thank you. And then I just wanted to mention we had a question, sort of comment come in that someone had heard from the Farm Service FSA that in order to qualify for loans, that all warm bodies needed to have a Social Security number. And so I know in our next webinar, we're going to have a representative from both RMA and FSA online, so we can get into, answer those questions and see what they have to say on that number, just so we're giving everybody the right information. And we can follow up on that too after the webinar.
Great, yeah, and I'll just say really briefly that I think where it becomes possible for someone to be, they can't receive benefits directly, but they can be a member of a corporation that does, as long as they're a minority member or owner. But to receive benefits directly from, USDA agencies, generally speaking, you need, to be a permanent resident or a citizen.
Okay, Great, thanks. So I think we'll move on to the next section, yeah, so we'll have a little bit of time at the end of the webinar for additional questions, but we'll just keep on moving.
Great, so we have probably about 5 more minutes then, and we'll, is that right? Be ending at 1.
Yeah, about
for presentation. Okay, perfect. So yeah, so the next section of the business health assessment is labor and contractors, and I'm just wanting to note the topics that are covered there. So the first slide, labor and contractors, and there is let's see here, a good fact sheet that is part of the business health assessment tool. And then on the next slide, there is an image and link to a resource that FarmLink put together with NCAT and some other organizations, a guide to labor laws for small farms in California. So I encourage you to check that out. Then if you go to the next slide, the next section of the assessment focuses on production and marketing, and there is a fact sheet that focuses on the Food Safety Modernization Act, and there's a lot of information out there about that, but I think the fact sheet is addresses the kind of the risk areas in a succinct way, so worth looking at. And then I think, with the time that we have remaining, I want to talk about credit and understanding credit. So if you would go to the next slide, Megan, where there's text on understanding credit. So, credit enables us to obtain goods and services before we make payment for those goods and services, and that transaction is based on the trust that payment will be made in the future. It's one way to think about it. Credit is also thought of as, well, how's your credit? Well, that's referring to the record of your personal debts and your history of repayment. Credit can be a really powerful tool. It can also be a burden, and some tools that you can use to kind of take more control of your credit is a credit report. Looking at your credit report, and a little bit ahead, there's a slide that has a link to where you can get a free credit report, but also understanding what your score is. And so, Megan, if you could go to the next slide where the credit scores are, we have credit scores listed from the maximum score you can have is an 850 all the way down to, this goes down to 500, but I think scores can go as low as 350, if I'm not mistaken, in the 300 somewhere. And these are categorized here, based on what financial institutions consider those scores. And so often, if, for instance, if you're trying to buy a house, you may be told, or trying to get a better interest rate to buy a vehicle or something, that the lender may tell you, if you have a 700 credit score, then you're going to qualify, or you'll be able to get a better interest rate. And so, knowing what your score is, you can often find out now from, if you have a credit card, many credit card companies are now providing that information monthly on your statement, or providing you a link to get that information. If you would go to the next slide, Megan, understanding what affects your credit score is really important. So if you're trying to improve it or understand why it isn't where you want it to be, here we can see, what are the components of the score. And so, the bulk of the score is made up of your payment history. So obviously, making on time complete payments is going to reflect positively on your score, but then also your capacity or your income to be able to cover those payments that you have committed to when you take on debt. But then some other factors that go into your score, which are not insignificant, are the length of credit history with a particular company, and they're referred to as trade lines on the credit report. Having a diverse mix of types of credit, so revolving credit, such as credit cards, installment type credit, which would be something like a vehicle loan, which has a fixed term and amount that you owe that you pay usually in fixed payments, and then new credit and inquiries on your credit. So if you're trying to obtain credit and your credit report is being pulled by potential creditors, that is going to affect your score. Not a whole lot, but it can add up. And so knowing what your score is and what issues on your credit report are is really valuable when you're shopping around for credit. If you go to the next slide, Megan, Understanding Credit, that's the website where you can actually obtain a free credit report annually. And I don't believe that it shows what your credit score is, but it will provide you the detail of all of the, the debt that you, or and accounts that you've had currently and in the past. So when you're going to access credit, if you can say, well, I know that my FICO or credit score is X, and these are the issues that I have, and I'm addressing them, in order to get a sample term sheet of if you were to borrow $10,000, what kind of rate would they be able to offer you? You can prevent them possibly from needing to pull your credit report to provide some preliminary information. So it's really helpful not only to be managing your credit successfully, but also to be shopping around for credit and reducing the number of times that your credit report gets pulled. So Megan, if you'd go to the next slide for me, Understanding Credit. Just want to cover briefly the 5 C's of credit, and this you could think of as kind of a framework that lenders use when they are considering making a loan to someone. And the first C is character, and you could think of that as the prospective borrower's willingness to repay. So, have they repaid their debts in the past? Do they, can you get a good character reference? So those are some of the things, that FarmLink will do when we're making a loan. We'll pull someone's credit, we'll talk to folks that they do business with, and we'll be able to get a sense of their character that way. The next C is capacity, and that really boils down to someone's ability to repay. So in the case of a farm or ranch, do they have the experience to produce what they're going to need in order to repay the loan? Are they able to repay? We'll be able to check the capacity box. On capital, we'd be looking at the owner equity or the amount of investment that the potential borrower is putting in. So if you're buying a tractor, like if you're thinking about Rick, he put $8,000 into that $30,000 capital improvements or purchases that he made. So that's how the capital piece would be thought of there. So he is putting in a little over 25%, which is is a decent investment, and expecting the lender to come up with a 75%. So it's a reasonable risk for the lender there. The collateral addresses what will be the collateral for the lender. In the case of the tractor, the loan for the tractor would be the collateral. Often a business lender will require a blanket lien on all the business assets as well. So when you purchase a vehicle that has a title and a VIN or vehicle identification number, the lien holder or the lender that provides the financing is listed on the title. With a tractor and with most farm equipment, there is no title per se, and so a UCC or Uniform Commercial Code filing with the Secretary of State is the way that those debts get recorded and tracked, and so something to be familiar with, and when they're being filed because of a debt that you're taking on, but also to make sure that they get removed when you pay off a debt. And then finally, conditions. The last C is really about any particular conditions that a lender may want to impose in exchange for making the loan. And these are things that are kind of in addition to what the term of the loan is, what the interest rate is, but more about, for instance, if there's been a weakness in the business that the lender would like to see addressed, they may say, well, we want to see cash flow projections on a quarterly basis, or something that's a very, very common condition in business lending is if the loan is for more than 1 year, that at the annual, when the tax returns are available, for those to be provided to the lender to just be able to monitor the health of the business. So I'm going to stop there because I know it's 1:30. I have a little bit more to cover, but just wanted to check in with you, Megan, about how to proceed.
Yeah, so I think we're going to run a little bit over, if that works for you, Britt. And then I know some of you may need to jump off, and participants may need to go on to other things. But we'll be sending out a recording of the webinar to everybody. So if you need to leave now, you can check out the recording later and hear the remainder of the content. So yes, Brett, why don't you just keep continuing and we'll move on.
Great, thank you. So if you would move on to the next slide, preparing for financing, or the slide ahead of that. So a couple of, I think, important pieces of advice from a lender's perspective when you're thinking, so if you're a farmer or rancher thinking about borrowing money, while this sounds basic, you'd be surprised to hear how often it happens, where someone knows they need funds, but they haven't crystallized exactly why and how to convey that to the lender. So really think about how much you need, what you're going to use it for, and what your options are for obtaining that credit. And then really think critically about if that thing that you want to purchase or do, how critical is it to the health and success of your business, if there are ways to get at that. If there are other ways to achieve that goal, or if you can stage it over time. And again, credit is a really valuable tool, but just want to be looking at all of your options. So think about these questions before you're going in to talk to a lender, know what your credit score is, any issues that may be on your credit report is really important. It's just going to engender confidence on the part of the lender, that the business person that they're sitting in front of really does understand their business and knows how a loan will be able to help them. So if you go to the next slide, Megan, 3 kinds of financing there. The first type is debt, and that's the most common for small businesses. You get to maintain ownership, complete ownership of the business, but you have to repay the loan with interest, of course. And if you're not able to repay the loan on time, then depending on the terms of the loan, the lender may be able to extend the term, or they may require you to, sell the collateral, or, depending on communication with the lender or lack thereof, collateral can be repossessed as well. So communication is key in those types of situations. Equity is another form of financing, and equity by definition requires that you give up some of the ownership of the business, as well as earnings, and potentially some control if the equity partner is looking for that, but it injects capital into the business without taking on additional debt. So instead of having a loan on the liability side of your balance sheet, you have someone that, in addition to providing capital, may be providing other types of management support or industry connections and things. So it's definitely something to understand and to be aware of, and it can be really powerful for some small businesses, particularly as they're growing. And then, of course, there are gifts, and they can be really important for the launching and growth of small businesses, and they can also be combined, to great benefit when you're seeking financing as well. Combining a gift with a loan to purchase a piece of land or a piece of equipment or infrastructure can be really helpful. And there are some places online where you can raise that kind of capital as well, which we'll touch on in a minute. So if you go to the next slide, Megan, on financing options. Just looking at this from a slightly different perspective, of course, savings and gifts from friends and family are important. Even loans from friends and family can be really important. But some of the more typical kinds of debt that we see businesses taking on, credit cards are very common, and they can be useful to a point, and they can become a burden after a while, depending on the terms and how you use them. Lines of credit are really useful tools. They sometimes have conditions that require you to zero them out at a certain point in the year before you can re-access them. So understanding the terms of a line of credit are important. Term loans have a fixed term or length to the loan for a specific purpose. So they're designed for the particular use, as opposed to a credit card or line of credit, which are more flexible. The credit cards being the most flexible, of course. Lines of credit for businesses are structured or designed for the business, but you're typically not having to provide documentation about what you're using the funds for on an ongoing basis. There are, I guess, on refinancing, we often are at FarmLink seeing requests from farmers to refinance credit card debt, and that we generally think is a good thing, because not only with credit cards, but also with online lenders, fintech companies, and even payday advances, you see people getting into situations where interest rates or prepayment penalties are making it really hard for people to kind of break out of a cycle of debt. They're not able to get ahead, so we can refinance credit card debt that's been used for the business and help you get ahead with that. So something to think about if you're finding yourself challenged in getting off of the credit card kind of merry-go-round. We go to the next slide on financing options continued. For agriculture, there are a number of options, and we've talked a little bit about the Farm Service Agency. Haven't gone into detail about their loan products, but they do make loans directly, meaning you would apply and receive the funds directly from them, or you can work with a lender such as FarmLink or some of the ones listed here, American Ag Credit or other farm credit associations around the country. Cal Coastal is a regional small business lender, the Central Coast area, that also makes FSA guaranteed loans. So talking to a lender that is familiar with agriculture and makes loans to agriculture businesses is important, because they understand the business cycle and are in a position to be more flexible if you need to extend your term, if you have trouble paying, and especially if they're getting a government guarantee such as from the FSA, they're going to be in a better position to be flexible if you've had a crop loss or something like that. crowdfunding, peer-to-peer lending. There's quite a number of options out there. I think, you could think about ones that raise money that are gifts, essentially, like Kickstarter, Barn Raiser, and then ones like Kiva, which has a 0% interest rate, but it does need to be repaid. There's other ones like Lending Club and Prosper. They do have interest rates attached to them, but there are a number of options there. So obviously with online lending and borrowing, being able to provide information on the internet and having a customer base that you can be reaching out to in your process are critical to the success of raising money, whether it's as a gift or a loan. We're going to talk about FarmLink's loan program briefly in a couple of slides, but Megan, if you go to the next slide, the financing resources, I just want to point out a few resources here that I encourage you to check out. So FSA, or the Farm Service Agency, has a guidebook to their loan products, and it's linked there on the slide, so you can go directly to it and look at that. And then there's something that I think is a really good companion to that, which is something that the National Young Farmers Coalition put out several months ago, and it's titled The Ins and Outs of Growing a Farm with Federal Loans, and has a lot of great information, kind of helps you, from a lay person's perspective, understand the FSA loans that are available. And then another tool that the National Young Farmers Coalition created recently is a finding farmland calculator. And so you can simulate different scenarios based on, the amount, the purchase price of a piece of land, how much you can put down, if you would be working with the FSA and other lenders. So, if you're currently looking to buy land, or you're dreaming about it and want to know what you can do to, move in that direction, really encourage you to look at that tool. And I've got Kiva linked there as well. Kiva has helped quite a number of farmers, and Kiva lenders really like agriculture businesses, to support agriculture businesses. So please take a look at that as well. I think the typical loan size is $10,000, but again, no interest on that. So makes it quite attractive. Go to the next slide, Megan, where I'm going to talk briefly about California FarmLink's loan program. So this list just gives you a sense of what we're going to be looking for when someone applies for a loan with us. And I think this list is fairly, it's applicable to other ag and small business lenders as well. There may be some slight variations, but generally we're going to be looking for experience producing, running the business with the particular crops that you grow or planning to grow, understanding what your market plan is, who you have relationships with already and what may be new, looking at your financial records, which we've talked about in some detail. It's very common for a farmer not to have cash flow projections, and that be put together kind of in collaboration with the lender, but the information that's needed for the lender to put the cash flow projections together has to be provided by the farmer. So the more info you can provide, the better. What sort of assets and collateral you bring, so having a balance sheet comes in handy. The credit history and report the lender will pull, with upon formal application. The applicant, is authorizing FarmLink in this case to request a credit report, so we'll see your score and any issues showing up on your credit report. But again, anticipating that and knowing what's there can be really helpful, especially in an initial conversation with a lender. Your land tenure situation, particular lease agreement or proof of ownership, is going to be an important part of the application process. References in terms of people that you do business with, landlords, customers, vendors, all feeds into kind of the character piece of the underwriting as well. And then on the next slide, some basic information about the loans that we provide. So we can make loans of anywhere between $2,000 to $1.4 million. It can be used for annual operating expenses, to purchase equipment or infrastructure or vehicles. And within both of those categories, as I mentioned earlier, we can refinance other debt if it's been used for the business. And then for purchasing land or refinancing land, a loan that you have on a piece of land, we can do that as well. And the rates and terms really depend on the loan product, but give you a general idea on operating and equipment infrastructure loans. We have a fixed interest rate of 7% currently, and the term or length of the loan would really depend on what the use of the funds are and how the revenue that's going to be used to repay the loan is generated over time. And throughout the process of putting together the loan application and the underwriting, if there are questions, concerns, issues that come up in that process that are going to either be an obstacle to someone qualifying for a loan or just generally something that we think the business should address, to be a healthy business, we're going to provide, some referral resources and information resources. And as a nonprofit and a community development financial institution, we are first and foremost interested in helping farmers and ranchers find the access to credit that's going to best suit their needs. So if it's not FarmLink's program, we're often referring folks to other lenders if they can get more favorable terms or just a better fit, and often work in collaboration with other lenders to meet farmers' needs as well. So feel free to follow up if you have questions or interest in FarmLink's loan program. And then on the next slide is kind of the catch-all category, the last section of the business health assessment, which covers the business plan, insurance, and energy. And so these are a sample of some of the questions in that section. Do you have a business plan? Do you have crop insurance? Different types of insurance. On the next slide, you can see it asks if you have non-insured disaster assistance, and that you can learn about in the next webinar. Do you have a rainy day fund? Do you have a succession plan? So these are sort of broad risk areas that, in going through and filling out the assessment, you can really kind of create a learning plan, an action plan for yourself. And it definitely can be a bit overwhelming, but with the help of your team and an advisor, if you have one, kind of prioritize what out of all those different sections of the assessment, how are you going to prioritize your time in addressing the things that are most mission critical for your business. So I appreciate your patience. We went over time and I had some serious technical difficulties, but I hope that this was valuable, and happy to stay on for a few more minutes if there are questions, and feel free to follow up with me directly if you have a specific question. And I hope you continue to participate in the series of webinars.
Great, Brett. Thank you so much for all of that, very detailed information and for hanging in there with all of the technical difficulties. You did an awesome job. We did have a couple questions come in that we'll answer real quick and then wrap up. One person was wondering, when you incorporate the business, does the entity have to start from zero in establishing credit, or would your personal credit history be taken into consideration?
Yeah, I'm so glad that question came up, because actually I missed mentioning that. And the interesting thing about business credit and personal credit is that if you have a new entity, as the case with this question or scenario, the business isn't going to have credit, obviously, but the individuals who are the owners of the entity do have a credit history. And even if that business is not new and it has its own track record, the individuals that are the owners of that entity, their credit history is going to be important as well. So definitely essential when a business is new and it has no credit history, but also important in the future because you are the owners of the business, and your personal credit history reflects on the business that you own in the eyes of the lender. So that's my general response. Obviously there's nuance depending on a particular situation, but your personal credit history will be very helpful in the business establishing credit. Even so, it will continue to be in the future, even when you have established credit for the business.
Great, thanks. And then one final question is, what is an example of using equity for financing common to a small farm business?
Yeah, really good question. I think purchasing land is one. So if you think about the diagram with the people, activities, and the land, let's say you're a farmer and you have a business, you're operating as a sole proprietorship, you want to purchase land and you want to have an equity partner in that. You could incorporate the business entity, the entity that is actually carrying out the production and sales of products, and that the ownership of that entity could be set up however you would like it or need it to be, and then you could create another entity to purchase land with an equity partner, and that entity that owns the land would lease the land to the entity that operates the business on the land. And so that would be a way where you could bring an equity partner in to be able to have more control over more secure land tenure, but you wouldn't need to have them involved in the day-to-day operations of the business, the equity partner, that is.
Great, thank you. So I think we're going to wrap things up now. Thank you to everybody who stayed online. If you have any additional questions, Brett, I have your contact information up here on the screen, so feel free to follow up with Brett or me as well. So yeah, Brett, thank you again for joining us today. And it was a pleasure hearing all of the detailed information, and again, we appreciate that you kind of powered through all the technical difficulties.
Good. Well, I'm glad it came out okay, and I appreciate the questions. We had lots of good questions. Thanks,
Great.
everyone.
So we're just going to, a couple additional resources in addition to everything that Brett mentioned. Another organization that works sort of on the financial side of farming is Kitchen Table Advisors. So if you're in Northern California, that's another resource you can check out. And as always, the NCAT-ATRA website has lots of good resources. We will be having our next webinar in the series coming up in June, and then a couple later in the summer on record keeping for organic growers. And thanks again to everybody that stayed with us, and please fill out your evaluation form. It pops up when you close out of the webinar. We value your feedback, and it helps us develop new programs going forward. So thanks, and have a good afternoon.